In recent months, a renewed spotlight has been cast on the United States national debt, now surpassing a staggering $36 trillion. With fiscal pressures mounting and political debates intensifying, experts and financial leaders are increasingly vocal about the potential consequences of continued borrowing without structural reforms. Among the most notable voices is JPMorgan Chase CEO Jamie Dimon, who recently warned of a possible crack in the bond market stemming from the country's unsustainable fiscal trajectory. This essay explores the implications of the rising U.S. debt on the domestic economy and global markets, incorporating insights from financial experts and proposing potential solutions to avert a fiscal crisis. The U.S. national debt has grown rapidly over the past 2 decades, fueled by a combination of tax cuts, increased military and social spending, and economic stimulus programs. Particularly in response to the 2008 financial crisis and the COVID-19 pandemic, federal spending surged while revenues lagged. The Congressional Budget Office, CBO, projects that without intervention, the debt-to-GDP ratio could reach historically unprecedented levels within the next decade. That Jamie Dimon's concerns are rooted in these long-term structural imbalances. In a recent interview, he emphasized that while the U.S. has been able to sustain high levels of debt thanks to its position as the issuer of the world's reserve currency, this situation is not tenable indefinitely. If confidence in the U.S. government's ability to manage its finances wanes, investors may demand higher interest rates, which would further exacerbate the debt burden. The immediate concern with rising national debt is its impact on the federal budget. As debt grows, so do interest payments. These payments already constitute a significant portion of the federal budget and are expected to become the largest single-line item within a decade. This crowding-out effect limits the government's ability to invest in essential services such as infrastructure, education, and research. Moreover, rising debt can influence inflation and monetary policy. Although recent inflation spikes have been attributed more to supply chain disruptions and geopolitical tensions, persistent deficits can contribute to long-term inflationary pressures. The Federal Reserve may be forced to maintain higher interest rates to keep inflation in check, increasing borrowing costs for consumers and businesses. Credit rating agencies have also taken note. A downgrade of U.S. debt, like the one issued by Fitch in 2023, signals to investors that political dysfunction and fiscal irresponsibility could undermine the country's creditworthiness. Lower ratings can lead to higher borrowing costs not only for the federal government, but also for state governments and private borrowers who rely on the U.S. benchmark. Given the central role of the U.S. dollar and Treasury securities in global finance, rising U.S. debt has international implications. Treasury bonds are widely regarded as the safest asset in the world, serving as a benchmark for interest rates globally and a cornerstone of central bank reserves. A loss of confidence in U.S. debt could destabilize international markets, raise global interest rates, and lead to increased volatility. Emerging markets are particularly vulnerable. Many rely on dollar-denominated debt, and higher U.S. interest rates can trigger capital outflows, currency depreciation, and financial instability. This dynamic was evident during the 2013 taper tantrum and more recently during the Fed's tightening cycle in 2022 to 2023. China, the second-largest holder of U.S. Treasuries, has expressed concerns about American fiscal policies. While it remains in China's interest to support the U.S. debt market to protect its own holdings, ongoing geopolitical tensions may prompt diversification away from dollar assets, potentially reducing demand for treasuries and increasing U.S. borrowing costs. Jamie Dimon's warnings align with a growing chorus of economists and financial leaders urging fiscal discipline. Former Federal Reserve Chair Ben Bernanke has also highlighted the risks of unchecked debt accumulation, noting that while the U.S. is not immediately at risk of default, long-term fiscal sustainability is essential for economic stability. Nouriel Roubini, a professor at NYU and prominent economic commentator, has gone further, predicting that without significant reform, the U.S. could face a debt spiral scenario where interest payments consume most of the budget, leading to either default or hyperinflation. While such scenarios are considered extreme, They underscore the urgency of addressing fiscal imbalances. On the other hand, modern monetary theory, MMT, proponents argue that as a sovereign currency issuer, the U.S. can afford to run deficits without facing insolvency. However, critics of MMT contend that this perspective underestimates the risks of inflation and market backlash. To address the debt crisis, a combination of revenue enhancements and spending reforms is necessary. Tax policy is a critical area. Revisiting the 2017 Tax Cuts and Jobs Act, which significantly reduced corporate tax rates and contributed to the deficit, could help increase federal revenues. Closing loopholes and implementing more progressive taxation are also widely discussed measures. On the spending side, entitlement reform is essential. Programs like Social Security and Medicare are major drivers of future spending growth due to demographic trends. Raising the retirement age, adjusting benefits, and reforming healthcare cost structures could improve long-term fiscal sustainability without dismantling the social safety net. Another avenue is improving government efficiency. Reducing waste, streamlining bureaucracy, and leveraging technology can lead to cost savings across federal agencies. Additionally, implementing strict fiscal rules or debt breaks, similar to those used in some European countries, could help enforce discipline and reassure markets. Investments in economic growth also play a role. Policies that enhance productivity, education, and innovation can expand the economy, thereby increasing the tax base and reducing the debt-to-GDP ratio over time. Infrastructure investments, if well-targeted, can yield high returns and support long-term growth. The U.S. faces a complex and multifaceted fiscal challenge that demands urgent and sustained attention. Jamie Dimon's warning about a crack in the bond market is not mere hyperbole. It reflects growing concerns among financial leaders about the trajectory of U.S. debt and its implications for economic stability. While the country's unique position as the issuer of the world's reserve currency provides some insulation, it is not a license for perpetual deficits. To avert a crisis, policymakers must prioritize responsible fiscal management, balancing short-term economic support with long-term sustainability. This will require difficult choices, bipartisan cooperation, and a willingness to confront entrenched interests. The alternative, a loss of confidence in U.S. fiscal integrity, could have profound consequences for both the domestic economy and the global financial system. As the world watches, the U.S. has a window of opportunity to act. Whether it will seize that moment remains to be seen, but the warnings are clear and the stakes are high.